Well, back in December of 2007, just shortly after stocks peaked and the mortgage meltdown was brewing, our next guest was already saying that the subprime mortgage meltdown was just the start. He was right. We are talking about Whitney Tilson, founder of hedge fund T2 Partners. Whitney, welcome.
Thank you, Carol.
So the problems in the housing market not over by any means. What do you mean?
Well, it means we went through the biggest asset bubble in history, and it took years to build, and it's going to take years to unwind. About a year ago, when you mentioned I was here, a little over a year ago, I think investors thought we were in the 7th inning of the unwinding, and I said, no, we're in the 3rd inning. And today, in terms of the U.S. housing market, we're now probably in the 5th inning, but investors still think we're in the 7th inning,
right.
And so we're urging caution.
Got a million questions for you. So when we talk about some of those housing data points that are not necessarily getting a heck of a lot better, Whitney, but not getting much worse, right. I mean, are they significant? Do they show that we're bottoming out, or not necessarily?
Yeah, we're getting closer to a bottom. I mean, according to the Case-Shiller National Index, home prices are now down more than 30% from their peak. We estimate that they'll be down somewhere in the 40% range and might bottom sometime a year from now. So we're probably in the 7th inning of home price declines. But in terms of losses and write-downs, that tends to be a little bit of a lagging effect. So we may be only halfway through there.
And as we talk about, your book, More Mortgage Meltdown, I mean, there's other aspects of the market yet to fall, correct?
Right. I mean, there are a number of things going on. When I get asked, well, where are we? The answer is, well, it depends on what you're talking about. We're most of the way through home price declines, maybe halfway through losses and write-downs related to the U.S. housing market, but we may only be a 1/3 of the way through total losses and write-down because you've got commercial real estate and leverage loans and all the other bubbles that took place.
Jumbo mortgages, right?
Well, within the housing market, there are a number of other areas that are just starting to tip over, like jumbo prime and HELOCs, and even prime mortgages are now starting to default at historically unprecedented rates. So we're within the housing market, we're making the transition from really the bad and the low-end loans into the mid to high end is starting to tip over now because of the bad economy and unemployment.
Hold on for a second. We'll take a break. We're back with Whitney. I'm curious, Whitney, then, if you're worried about more mortgage meltdown, and I think you think that we're only, what, halfway through then?
In terms of write-offs and losses related to the U.S. housing market, I think we're about halfway through seeing those, maybe only a 1/3 of the way through total write-offs when you look at the entire bubble bursting.
So what's the impact on financials? Does that mean those stress tests we did didn't really tell us much?
Well, I think the stress tests were a very important first step that did, I think, correctly identify a number of institutions that needed to raise capital. I think, though, investors may be breathing a sigh of relief a bit prematurely here because we think stress tests really, to do it properly, should be ongoing. Regulators should be evaluating all of our big banks on an ongoing basis.
One would assume.
One would assume, and I think that is what's happening, but I think a number of institutions are going to need to raise more capital, and investors may be getting a little enthusiastic that this was the end of the process, and I think this stress test is the beginning of the process.
Well, then take the move that we've seen in financials, Whitney. I mean, we've seen quite a rally. Now, they were beaten down, severely. Does that rally make sense in your view?
Well, some of it does, and for example, we have entire chapters in our book, which was written really right as the market bottomed in early March, and so, for example, we spent a chapter on Wells Fargo, a chapter on American Express, saying why we thought those were screaming buys in the $10 to $12 range, and sure enough, they've doubled in a couple of months. We've started to book some profits there. We're still holding the position. We still think there are some blue chip companies that are going to be winners here. On the other hand, while we're long American Express, we're short Capital One. We don't think they're as well positioned. We think they're going to get hit worse with losses, and particularly the new bill that just went through Congress that's going to impact Capital One much more than American Express, for example. Similarly, Wells Fargo, we're long, but we think B of A is still going to have to raise a lot more capital than the market anticipates. So we're short B of A, we're short some of the regional banks, we're short the home builders.
You're short the home builders.
We are. We see really almost no need for any new houses to be built in the United States, given the waves of just foreclosures that's going to be coming, millions of foreclosures over the next few years. If I were czar, I would mandate no new home construction for a number of years, but I think the market is going to dictate that, and home builders are going to be under a lot of pressure for many years.
How long do you think it takes to really work down that inventory? I mean, if there's so much supply out there.
I mean, I'm thinking in terms of, 2 to 4 years before inventories return to any kind of normalized levels. It'll depend on individual markets. For example, I saw one report that Florida condos, there's something like 8 years of inventory out there.
Right.
But, generally speaking, the thing you have to keep in mind is you can't really believe the published numbers which are based on homes listed. There's what's called shadow inventory out there, which is banks have foreclosed on a lot of homes, and because they're so backed up or they're reluctant to take losses, they haven't even listed them yet. So, I've seen estimates, the official inventory is somewhere in the 9 to 10 month range. I've seen estimates that including that shadow inventory might be 15, 16 months. And then keep in mind there are a lot of homeowners that are underwater, they want to sell, they can't. So that's not really a shadow inventory, but those are sellers that will emerge the moment prices start to rise, and that's going to keep a damper on prices for quite some time.
Winnie, that's what I found so striking in your book. You have tons and tons of research and charts, and if you look at the charts, it's very clear kind of the crisis that we saw in the last year and a half or so, and really still how we're in a very tough spot still.
Sure. I mean, that's the point. The point of the sort of first half of the book is the title, More Mortgage Meltdown. This was an enormous, unprecedented bubble. It's going to just take time to work through it. The second half of the book, though, before everyone gouges their eyes out, is the subtitle, 6 Ways to Profit in These Bad Times. The first half of the book says things are bad, they're going to be bad for a while, but as an investor, how do you play that? And we actually think there are plenty of stocks to buy on the long side that are cheap, and there's some good shorts out there as well.
But you also write in your book that the mortgage meltdown and credit crunch are so severe that both the U.S. and world economies are likely to be weak for a number of years. That's pretty downbeat. Yes,
and that's the assumption that we layer into our investing decisions. But even so, even in an environment, we think that U.S. GDP is going to shrink the rest of this year, but at a declining rate, sort of reach a U bottom. There's not going to be any V-shaped recovery in either the housing market or the general economy. We're quite sure of that.
Right.
And how long we sort of go along that bottom is hard to know, but we're not anticipating any robust economic growth providing a tailwind for at least a couple more years.
All right, so you talk about strategy then. My understanding, you're long and short from what I got from the book. Is that still where you are?
Correct, yeah.
But more so long.
Yes, I mean, we've been positioned about 100% long, 50% short. So in the hedge fund terminology, 50% net long, 50-60% net long. As the markets rallied the past couple months, we've been trimming our longs, hanging on to our shorts because we want to position our portfolio more conservatively. This rally's been very strong, and we still think there's a lot of bad news yet to come.
And that's what I want to ask you, because I know when we talked, I think December or January, you talked about corporate America being on sale, and we've had quite a bounce, as you know, from March. I mean, is it still on sale in your view, or not necessarily as much?
Sure. Well, look, corporate America is generally talking about, S&P 500 big cap stocks, and we think you could, an average person could, without too much work, pick 5 or 10 big cap stocks. We have a whole chapter in our book on Berkshire Hathaway, which is our largest position. We own some Pfizer these days. We still own some Wells Fargo and Amex. You can put together a portfolio of stocks that are maybe 20 to 30% undervalued, and you'll do better than the market, certainly better than low-yielding bonds if you've got a 5-year time horizon. But don't get excited about any big bounce in the next year or two, would be my guess.
Do you anticipate a significant pullback based off the rally we just saw?
Look, I think we may have seen the bottoms of this downturn 2 months ago or so.
Right.
But it would not surprise me to see a sort of choppy market as we work our way through this very severe recession for the next couple of years.
All right, and your book does say 6 ways to profit in these bad times. You've got kind of 6 points that you make.
Well, we have 6 case studies of individual companies, 5 longs, 1 company that we're short. And the idea is to teach people who are interested in picking stocks, how we do it. So a very in-depth analysis of the companies and why we think the stocks are cheap.
And I know you talked in the book about, picking stocks and like flying a plane.
Sure.
The odds better.
Yeah, the opening chapter, the second half of the book, says you don't have to pick stocks. If you're just an average person out there, you got a full-time job.
Right.
If you're out there picking stocks, you're competing against people like me who do this for a living, and that's a tough game. So there's no shame in buying an index fund or some actively managed funds are worth buying too.